Hello, everybody, and welcome to the latest episode of At the Coalface Live with me, Jason Greenwood, your host. It is awesome to be here with you again this Friday, as I am nearly every single Friday afternoon for around 4 p.m. New Zealand time is when I tend to kick this off. And what we want to talk about this week, we've moved to a more of a theme-based talk on our Friday sessions together as opposed to purely news of the week. But there was a fair bit of big business news, big commercial news that was announced this week. Deals, talking about financials, quarterly reports, etc. So I wanted to talk about some of the more, I guess, the standout deals that happened this week, the standout financial announcements that happened this week in the world of digital and e-commerce. And I wanted to just give a little bit of my take on what my thinking is as these announcements started to hit the market, and based on my experience with the technology in question, oftentimes I wanted to sort of give my thoughts on what impact those financial announcements may have on the market and what the wider implications will be for the broader digital and e-commerce ecosystem as a whole. So I wanted to kick off with a very large and significant piece of news that was announced earlier this week. It was announced on the 1st, so 3 days ago, and that is that Australia's Zip Pay is to buy US buy now, pay later rival Sezzle amid a softening market. And this was all over the financial press, from payments all the way through to Reuters, Market Watch, etc. So there was a lot of commentary on this that hit the market, but Reuters was one of the first to break the story initially, and apparently the announcement was originally made by Zip, or their intention to make the purchase was announced on February the 28th initially, with the official announcement going out to the broader market on the 1st of March. And they called out the fact that buy now, pay later service Zipco is plans to buy U.S. rival Sezzle for Australia $491 million, or approximately USD $352.59 million, building its footprint in the largest retail market as a sluggish trade elsewhere earned it a half of a year loss. Zip and Sezzle, which are both listed in Australia, had previously disclosed that they were discussing a buyout. They said that they agreed terms on Monday, just as Zip confirmed an Australian $108.1 million loss for July to December, excluding one-off items, versus a small underlying profit a year earlier. Zip also said pre-tax loss halved to Australian $214 million when factoring in one-off items, including Australia $44.7 million impairment charge on its British unit, which it bought for Australian $50 million in 2019. It had previously blamed rising bad debt and disappearing COVID-19 stimulus payments for a weaker operating environment. The UK remains further away than we're comfortable with to continue to invest at the same rate, said Chief Executive Larry Diamond, Zip's founder and largest shareholder with 9.3% of its stock. We still believe in the global opportunity. What we're calling out is the investment strategy to core markets where we're closer to profitability, he said on a call with analysts. Cost savings by combining the two companies would see Zip turn a profit in 2024, Zip said in a statement. Wow, ambitious to call that out with such certainty, especially in an uncertain market. But in any case, the BNPL sector enjoyed a meteoric rise during the COVID-19 pandemic when online shoppers preferred alternative sources of credit for purchases. It has since consolidated rapidly, with Jack Dorsey-backed Block Inc.'s $29 billion buyout of Afterpay in August among the sector's biggest deals. Shares of Zip and Sezzle were in a trading halt as Zip sought to raise up to Australian $198.7 million in a stock issue alongside a planned all-stock buyout of its U.S.-focused rival. So no cash will change hands in this deal. And it says, while we see the acquisition of Sezzle as positive in terms of reducing the cost base, we expect the focus to be on delivering on the revenue synergies, said Citi analyst in a client note, pointing out that Zip's half-year results had been pre-announced. Now, when we start thinking about this, we can't just look at this deal in isolation. I've been watching the BNPL space for a long time now, and none of these BNPL providers seem to be able to turn a profit. You know, we obviously had Afterpay being bought out. It never turned a profit. We have Zip not being able to turn a profit. We have Klarna struggling to turn a profit. We have all these major global players struggling to make money off of buy now, pay later. we even have some of the local players that are really struggling to be profitable in this market, and it shows just how competitive it is, how many players there are in the market, and how it is being servicized, this buy now pay later service, as opposed to a product. So when Zip obviously released their initial BNPL service, the same with Klarna, the same with Afterpay, the same with Laybuy, the same with all the major players, they have those as kind of a standalone product. Now, what we're seeing is that these products are being turned into additional services being added to much, much larger fintech players like Block. And so what we're seeing is a dramatic consolidation in the space, because not only was there already an absolute mountain of consolidation, but there was a flood of new players coming to market with no one seeming to be able to figure out how to make buy now, pay later profitable. Now, one of the reasons why buy now, pay later has really struggled to achieve profitability is not just the margin compression that they've seen in the competition that they've seen, but also because the credit nature of the product is similar, I guess, in many respects to a credit card. So if you've got a credit card with 30 days worth of rolling credit, then you may not necessarily see the value in a pay in 4, pay in 6, pay in 10, whatever kind of combination of offerings that these individual buy now, pay later firms offer. And you'll see it as maybe additional free credit. Sorry about that dog barking in the background there. But you may see it as additional free credit extended on top of your credit card credit. But you're really seeing that as an extension of existing credit, not necessarily viewing it as brand new credit, even though it is technically new credit. And the buy now, pay later services have fought tooth and nail with regulators to prevent their products being classified as a traditional credit product, which in historic terms, traditional credit products are very, very tightly regulated in the market. So we not only have growing competition in the market, we not only have consolidation happening in the market, but we also have global regulators already starting to message to the buy now, pay later industry that regulations are indeed coming, that they have been able to sail under the radar long enough. They haven't been treated as credit products, so therefore they haven't been as tightly regulated. And so therefore, for example, they were unlimited in the types of fees that they could charge merchants to provide effectively their payment gateway services through the likes of e-commerce websites. So not only were their fees absolutely stratospheric, but all of the major buy now, pay later services do not allow merchants to pass those charges on to the customer in the form of a surcharge. So we have this sort of wild west of the buy now, pay later industry, and they were really taking it to merchants in terms of the fees. They were basically gouging the market. And even whilst gouging the market and not charging end consumers any fees at all, so gouging the merchants, they still have not managed to figure out how to make this service profitable. Thus why you're seeing these services that were products as standalone products on their own right, and standalone platforms, you're starting to see them consolidate as simple additional enhanced service offerings with other payment and fintech platforms instead. So it's going to be very interesting as the major players continue to get snapped up. So the major buy now, pay later players, which are dwarfed by the major global fintechs, the likes of your PayPals and your Stripes, etc. So all of your buy now, pay later players, even though they're billion-dollar companies and many of them are unicorns, they are still dwarfed by your more traditional fintech companies that provide a wide range of financial services and financial products to the market, and payment services and plumbing and rails that can be used globally. So I think when we see this kind of ongoing consolidation, we're going to see a shakeout here. We're going to continue to see this industry contract. We're going to continue to see this industry consolidate. It was very much like the daily deal industry that we saw, about 5 to 10 years ago. It exploded. We had thousands of daily deal sites popping up around the world, both local, regional, and global. And then we saw a massive shakeout here in New Zealand. We saw, for a while there was like 10 major daily deals websites, and I think there's one or two, maybe three at the most, daily deals websites that have managed to survive with one or two absolute standouts. Same in Australia, same around the world. We saw daily deals websites just reach fever pitch, and then we saw massive contraction and consolidation and nesting underneath much larger e-commerce brands that had traditional retail as part of their core offering. And then we saw the daily deal function become a service nested underneath that broader e-commerce offering. And we're starting to see that now with buy now, pay later. I believe we are also going to see that with global marketplaces. Global marketplaces are absolutely exploding, particularly in Australia. Not so much down here in New Zealand, but definitely in Australia. There seems to be a new marketplace launched every week, it feels like. I believe that we are going to see mass consolidation. Once we reach fever pitch and there are too many marketplaces for the demand, it's a classic supply and demand scenario. At the end of the day, there's a limit to the amount of demand that is out there. Therefore, as supply continues to grow, competition will increase, profitability will decrease, and all these major marketplaces will cut their costs to the bone to compete, but ultimately not all will survive. And we're going to see that in that space, just like we've seen it in the buy now, pay later space. And we see this mania happen across all sorts of new technology. Once it's released, we see everything go manic. We see everybody jumping on board. We see lots of new service providers joining the fray. And then ultimately what happens is the best and brightest survive while almost everyone else gets either bought out, consolidated, shut down, competed out of business ultimately. And they ultimately leave the market in one way or another. And that is the way a healthy market is supposed to operate. You have to find that ultimately that equilibrium in the supply and the demand curve, and they meet in the middle to where everybody who's remains in the market can actually be profitable at the same time. So very interesting to see this massive deal. Also interesting to call out that the purchase did not include any cash. They were able to buy Sezzle out of existing Zip shares, although as the Reuters article called out, they were going to be issuing additional shares to finance operations because, again, they're not profitable. They're still losing money. So they needed to sell more shares to finance ongoing operations as opposed to using the existing shares, which is what they were doing to buy Sezzle. So basically trading shares. So going to be very interesting to see how this one ultimately plays out. Now, we also saw BigCommerce report their Q4 earnings this week. And the earnings were not incredibly pretty when we look at the holistic view. That wasn't that pretty. BigCommerce Inc. Reported its earnings on Monday. It reported a loss of $34.2 million in its fourth quarter. The Austin, Texas-based company said it had a loss of 48 cents per share. Losses adjusted for non-recurring costs and stock option expense came to 17 cents per share. The results did not meet Wall Street's expectations. The average estimate of 9 analysts surveyed by Zacks Investment Research was for a loss of 13 cents per share. So the estimate was 13 cents a share, and they came in at 48 cents a share loss. The company posted revenues of $64.9 million in the period, surpassing the street forecasts. 9 analysts surveyed by Zacks expected $62 million in revenue. So definitely revenues were higher than expected, but so was the loss. For the year, the company reported that its loss widened to $76.7 million for the year, or $1.08 per share. Revenue was reported at $219.9 million for the year. BigCommerce shares have decreased 27% since the beginning of the year, and the stock has fallen 56% in the last 12 months. So what we're seeing here is we're seeing this hyper competitive environment for e-commerce platforms, particularly SaaS e-commerce platforms. Obviously, Shopify being the 800-pound gorilla in the marketplace, BigCommerce is trying to compete with them in many respects, but what they're really going after is they're going after the higher enterprise end of the market, and they are also going after the B2B end of the market. Shopify notoriously doesn't have really hardly any B2B functionality natively in the platform, and they notoriously don't go after enterprise customers. They go fairly and squarely after the mid-market, maybe mid-enterprise customers, and they do have some very, very large enterprise customers, but it's certainly not their target market. They're after the mid-market, they're after the mid-enterprise or mid-enterprise market, but they do not target the enterprise end of the market. BigCommerce, on the other hand, in order to carve out its own unique niche in the industry, they are trying to carve out a space for themselves by going after the bigger end of town, and they're trying to convert their dependency on their lower tiers of their subscription offering. They're trying to pivot that into more of that more dependable, more sticky enterprise end of the market. And the reason why that end of the market is more sticky is not just because you're paying more, but because when you get up to that end of the market, typically you're talking about highly customized implementations of the platform as opposed to your vanilla, very lightly or zero customization implementations. And so what that means is if an enterprise business has put, $1 million or $500,000 into an implementation of their e-commerce platform and all of the required integrations and all of the required supporting technology, they are not going to rip that out without a lot of thought, without a lot of deliberation, and without usually getting a massive ROI on their existing investment before they consider a replatform project. So I like the direction that BigCommerce is headed. I like the fact that they are growing their B2B functionality when they bought B2B Ninja and Quote Ninja. B2B Ninja is Quote Ninja. They Quote Ninja trades as B2B Ninja or vice versa. I can't remember, but anyways, they bought those. They bought those guys last month to enhance the quote management functionality of the platform. They obviously have a tight deal with Bundle B2B and the B2B edition of BigCommerce. So they're definitely expanding B2B functionality on the platform. It's already got good underlying functionality with price lists and customer groups and store credits and all sorts of other native out-of-the-box functionality, but they're enhancing that functionality through third-party partnerships and third-party acquisitions like the B2B Ninja deal in February. So I like where they're going with this. I like the fact that BigCommerce is heading in a direction where Shopify is historically and traditionally weak. So they're not going straight up head to head with Shopify for that lower end of the market, which, let's be honest, at the lower end of the market, it's easy for businesses, or easier for businesses, to chop and change between e-commerce platforms. If you don't like Shopify, you move over to BigCommerce. If you don't like BigCommerce, you move over to Shopify, or you move over to one of the many other sort of mid-market or lower end of the market e-commerce SaaS platforms. And so I do like where BigCommerce is going with their overarching strategy. I just hope that they don't run out of cash before they're able to see that come to fruition, because they are continuing to lose money. They are continuing to pour a truckload of cash into product development as well as sales and marketing globally to continue to grow their brand and continue to grow their footprint globally. So it is going to be very interesting to see how this plays out over the next couple of years, now that they're a public company, now that they're open to public company levels of scrutiny, now that their financials are an open book that have to be published every single quarter. Obviously, they will be put under the investor spotlight every single quarter, and they will be expected to perform if they want their share price to reverse course versus the last 12 months. If they want that to reverse course and start climbing again, then they're going to have to put their money where their mouth is, and they're going to have to not only grow revenue, but they're going to have to, at some stage, get to a place of profitability as well. So let's watch this space. I do like their overarching strategy. Let's see how they're able to execute. Brent Bellum is an executor. Look, he's the CEO. He's turned around and grown massive companies previously. So he's a sharp operator. He gets the financial considerations of these types of situations, and he's taking companies public before. It's not his first rodeo. So I expect Brent to handle things in a very smart way from a financial perspective and from a communication with Wall Street perspective. So let's just see how this plays out. Now, another large acquisition that happened this week, although exact terms were not disclosed, was Epic Games announced that they were acquiring music platform Bandcamp. And again, this was all over the digital press. This specific article comes from The Verge, and it says Epic Games is acquiring independent music storefront Bandcamp. The company's announced the news today, saying that Bandcamp would keep operating as a standalone marketplace and music community, but use Epic's resources to expand internationally and continue to adding new features. An Epic blog post says Bandcamp will play an important role in Epic's vision to build out a creator marketplace ecosystem for content, technology, games, art, music, and more. An announcement from Bandcamp co-founder and CEO Ethan Diamond, meanwhile, emphasized that the core deal for artists won't change in the near future. The products and services you depend on aren't going anywhere. We'll continue to build Bandcamp around our artist first revenue model, Diamond wrote. You still have the same control over how you offer your music. Bandcamp Fridays will continue as planned, and the daily will keep highlighting the diverse, amazing music on the site. But Diamond says Epic and Bandcamp will work together behind the scenes to push development of merchandising and payment options, mobile apps, and live streaming, among other features. Epic is primarily known as the publisher of Fortnite and the creator of the Unreal game engine, but it's made non-gaming acquisitions before with group video chat House Party. The company shut down House Party last year after acquiring it in 2019, and its team was apparently folded into a larger push to expand Epic's social features. Bandcamp, however, has a much greater existing fan base and clearer economic model than House Party. It's widely beloved as an alternative to streaming platforms like Shopify that offer less control and smaller revenue shares for most artists. Epic describes Bandcamp as committed to fair and open platforms, a subtle nod to its ongoing fight with mobile storefront operator Apple and Google, whose payment models it's described as a threat as it expands its gaming offerings to a larger social metaverse. Music has been a key part of that expansion so far, mostly in the form of performances inside Fortnite. Now the Bandcamp acquisition is giving a broader foothold in the medium. Now, what this means to me, and I'd never heard of Bandcamp prior to this announcement, this acquisition announcement. That doesn't necessarily mean anything because I'm a Spotify diehard, so listen to most of my music via Spotify. But so it makes sense that I wouldn't have heard of Bandcamp. However, what we're seeing is a merging of these content publishers, for lack of a better term, content providers, content publishers, and content ecosystems is really what we're starting to see. So regardless of whether you're creating video, whether you're playing games and creating assets for games, creating NFTs for games, or whether you're into music, what we're really talking about here is the creator economy starting to gain steam. And again, we are starting to see consolidation of these creator platforms underneath much, much larger, much more powerful brands. So we're seeing the smaller brand, the smaller marketplace in Bandcamp being nested as an additional service underneath Epic Games. And we're going to probably see further consolidation into Epic Games in order to, I guess, let's see. Let's just see how they play this out. But I can certainly see an area where there's an overlap here, where some of the music that is on the Bandcamp platform could be folded into the game engines as a tool that when you are building out games on their Unreal Engine, you then have audio assets that you can immediately bring into the game that perhaps come under a centralized licensing umbrella. So you're not only licensing the game engines, you're potentially licensing the music. You might even be able to start licensing some underlying snippets of code that start to get you much closer to your end goal faster, because the ecosystem that Epic is building will allow you to create content at scale quicker and more easily because they're all pre-integrated together. So that's what we're really seeing in the market from a broader platform perspective. We're seeing these large acquisitions, obviously with when we see massive behemoths like Microsoft acquiring platforms like Activision Blizzard, we know where this is headed. We know that these large umbrella companies are acquiring these very niche content play platforms so that they can nest them and integrate them into the wider ecosystem that they offer across all of their technology platforms. So the ability to cross-sell, the ability to upsell, the ability to bundle as a platform grows as you acquire other technology to nest inside your parent or master technology. So I think that is what this type of deal signals, is a continuing consolidation of creator platforms, regardless of the type of content that those platforms support natively. Now, the final deal of the week that I want to talk about is the fact that Charged Retail and Reuters and a few others called out the fact that Peloton founder John Foley offloads $50 million of stock this week. Now, this follows an earlier offloading in 2021 of over $100 million worth of stock, when obviously it was worth a lot more. So Charge called out, it says Peloton co-founder and executive chair John Foley has sold around $50 million of stock to MSD Partners, marking his largest stake sale. The move comes a matter of weeks after he stepped down as the company's chief executive after the company lost 80% of its market value in approximately 12 months. Ex-Netflix and Spotify executive Barry McCarthy, of course, has since taken over from Foley. Foley's offloading of his 1.9 million shares is MSD Partners' first investment in the fitness tech brand, which manages $20 billion in assets on behalf of Dell Technologies owner Michael Dell. Peloton is an exceptional brand, and MSD Partners is pleased to have this opportunity to back Barry McCarthy and the Peloton team as they position the business for long-term growth. MSD Partners chief executive Greg Lemkow told the Financial Times. Foley offloaded his shares at $26 a piece, which was drastically lower than the share peak of over $162 in late December of 2020. This decision to exercise some stock options and sell those underlying shares in a private sale to MSD was John's decision based on his own financial planning, Peloton told the Financial Times. Activist Peloton investor Blackwell's called for Foley's resignation after it accused him of unbridled optimism that led to uncontrolled overheads and bloated inventories. Blackwell's was also not impressed that Foley had sold nearly $100 million worth of shares in 2021, calling the move excessive. Now, what strikes me about this move is the guy sold $100 million of shares last year. I highly doubt that he's short of a bob, yet at this critical juncture of the business where he's handed over the CEO reins to a new CEO after some, admitted commercial blunders that he made. He called out the fact that he probably honestly wasn't CEO material, although he obviously was founder material because he helped found Peloton, and he's executive chairman now. So he's probably getting paid a fair bob as that role. He's gotten the golden parachute, no doubt. And I'm sure he gets paid plenty. So the optics of this are not good. The optics of selling $50 million worth of Peloton stock at a point where it's been absolutely battered over the last 6 months and has been hammered down from its original peak. It's like 1/6 of its, it's less than that, less than a sixth of its original peak. And so the optics do not look good around this. Now, obviously, he doesn't care. He's rich. He can do whatever he likes. And these are his shares to sell however he likes. And I'm not questioning his right or his legal ability to sell these shares, but I do question the optics around this. And I'm certain that new CEO Barry McCarthy probably not necessarily that happy about the optics on this one, particularly as he tries to rebuild the brand and as they start to release their new technology platform, which allows other technology makers as well as other hardware makers to get on board with their underlying Peloton technology, their streaming technology, and I think they've called their new technology platform Off Ramp or something like that. I'll get into that soon once the information is more widely available to the public. But they're clearly, Barry McCarthy is a smart operator, and he knows how to create a very, very successful subscription platform. However, at a time when you are trying to rebuild morale in your company, internally, when you're trying to rebuild faith and confidence from Wall Street in your business, and especially inside the major VC community and the private equity community, when you are trying to completely reorientate, restructure the entire company from the ground up, including the revenue model and the go-to-market model for the entire business, when you're basically trying to prevent the business from going bankrupt, to have the former CEO in literally weeks of you taking over as the CEO, to have him dump $50 million worth of depressed stock value shares onto the market, it sends entirely the wrong message to the market. It sends a message to the market that John has less confidence in the future of Peloton than he did in the past, that he has zero confidence that the share price is going to recover anytime soon. He would rather take a hit today at $26 a share than the potential future decreases in the share price, at least in the short term, until maybe we start to see a recovery under Barry McCarthy, but that may be 2, 3, 4, 5 years away. Who knows? So this is just horrific optics. And we've seen this from some other great founders in the past, and they will take money on an exit or take, a massive chunk and selling off a massive percentage of their shares, particularly when a brand goes public. Oftentimes that's a massive exit event or a liquidation event for major shareholders and major founder shares. And we see the same thing with massive liquidity events when VCs buy a big percentage of a company or private equity buys a big percentage of the company. That is almost always seen as some form of a liquidity event that benefits the original founders and shareholders of the company the most. But to do this so late in the piece and after the company has has absolutely been put through the ringer over the last 12 months. Horrible optics. So again, don't question his ability to do this or his legal ability to do this, but I do question the logic of doing this, particularly right now. And I think he's actually made an additional rod for Barry McCarthy's back in the process. But of course, time will tell. So, anyways, that is the biggest news, I guess, some of the big financial news of the week that stood out to me. I wanted to give my take on that. I wanted to sort of give my thinking, my underlying thinking when I read these articles, when I see these announcements, some of the thought processes that I go through. I try to dissect these in a level of detail so I can at least understand the likely impacts to the broader market in the process. I'm an investor in the broader market as well. And so I want to have a good understanding of what's happening in the broader marketplace, particularly in the context of global events. So anyways, I hope you have found that interesting. I hope you found it insightful. I hope it helps you to start thinking about some of these large financial transactions and financial events that happen in our industry. I hope it helps you to start understanding the likely impacts that those are likely to have in the long term for all of us that are playing in this space. Have a fantastic weekend. It's been lovely to be with you. Can't wait to be with you next Friday. Have a fabulous weekend. Talk soon, guys. Thanks. Bye-bye.